record,
customized solution for
and
how
let your
you're going to
idea
deal with
fly.
that personally with what you need.
The future of your
That's to
startup
us
could
what
be
it really
just
means.
one
So
video away.
it is, though, a balancing
Remember,
act because you want to be able to do
be
that
clear,
scalably.
be
So that's why I
passionate,
mentioned about the
and most
collision.
importantly,
Sometimes
be
personalization
you.
runs counter to
We
scale.
can't wait to see what
Scale
you've
could
got.
unlock it.
Let's get funded
and
now.
start to get into a echo chamber of complexity.
Where do you come in, though, when it comes to personalization? Because these RIAs who you support, they're the ones who are the ones doing the personalization for their clients. Where do you come in?
I mean, we continue to be very pro-open architecture. If they want a solution that we haven't yet explored, we're willing to look at it. I think, though, what we have to do now is make sure we're making that as simple as possible. Because if we just keep layering tech on tech on tech, those things don't work together the right way. And they have to work together for people first and foremost. So you got to skinny it down a little.
Do you care if they use a Schwab ETF versus a Vanguard ETF?
Completely agnostic to the offer solution. We're proud of our solutions. We do have some great optionality in the wealth management space. So do third-party providers, and it's all about really finding what advisors need.
You began your career on the Schwab trading desk, Schwab. But I do also think about, it's so funny when people are even in broadcast, I'm like, go and do as many different jobs, and then you really kind of understand the industry. Tell us about that experience and how that has helped you to where you are today, and kind of understanding what's needed.
Yeah, for me, that is how I got where I am. I've been at Schwab for 30 years, and I've done just about every job, all of it in the advisor space. So I got to grow up watching this industry grow up.
Right.
And seeing both client service delivery, what do advisors need when they are calling us and relying on us for a solution, as well as what those solutions need to be. And that's kind of where I sit now, is trying to bring these offer solutions to the table, whether it's tech, whether it's a product solution, got to harmonize it. So it's been a cool journey.
What would the Jelena of 30 years ago be like, kind of shocked about what's going on in advisory services today?
Oh, wow. I think the proliferation of technology, really, not to harp on technology too much, but I think RIA space has been growing so quickly that you have seen such opportunistic advancements. And so I think looking back 30 years ago, thinking, okay, back then you've got to trade on a faxed piece of paper.
Right.
That's where we've come from. Now you could get it via a fixed connection. You could do it direct on the website. You could submit something through your own portfolio management system. So I think that complexity that I talked about a few minutes ago, it's here, it's real, and we've got to help sort of simplify and smooth out that ecosystem for advisors so they can spend time on their clients, which is the most important thing.
What's interesting is Schwab has its own advisors also. So I could walk into a Charles Schwab brick and mortar location in many different cities and towns across the country, or I could use a registered investment advisor who on the back end uses a Charles Schwab product as for a custodial purpose. Which one do you prefer?
I got to say, I don't have a preference. It comes back to the client's needs and what they desire. Some clients want to work with somebody in a physical location that they can walk into, touch, see, feel. RAs can do that. We can also do that in other parts of our business ecosystem. But really, let me put it this way. We have in our space $4.5 trillion worth of assets under custody. For half of the company's size. Our company believes in the power of RIAs as well as what we do on the retail side. And there's plenty of opportunity, $37 trillion worth of opportunity out there for us all to serve those people and meet their needs. And it's really about the clients.
All right. So I got to say, coming off that AI panel that I did this morning, somebody came up to me, one of the advisors. Schwab needs its own ChatGPT, using information that Schwab already has, tying it into performance and to the analysis and future analysis.
This advisor is spot on, and we're working on this right now. So we're going to start internally.
Okay.
We're doing a chat GPT-like solution for our service professionals so that when advisors are talking to us,
right,
they get the right answer the first time. But what we're going to do is extend that into our internet solutions so that advisors can access that directly too. So we're on track for that.
What does it look like?
It really just looks like a knowledge assistant. You ask it questions, much like in the session this morning where they're typing in the questions, and it's going to feed you back the best answer.
How are you training it?
A lot of trial and error. Actually, we have been practicing on it for 6 or 8 months. The early hit rates, certainly some failure rates, we've seen that go up by about 40%. So started with about 40% accuracy. We're about 85% accuracy now. So it's continuously learning because people just keep feeding questions in.
But who's feeding questions to it? And is it
our employees?
So, but when if I'm a customer of Charles Schwab and I call Charles Schwab, would you be able to use my question to somebody on the phone, then to help train that AI?
Yes, and that's exactly what's happening. They're using it on the phone and typing it in response to a client inquiry. So it's really cool.
Does it get to the point where it listens to me and then automatically gives the answer to whoever I'm talking to?
Yes, our voice technology actually can pick up not just on what they're saying, but the emotion of what they're saying too, and flag if, hey, we need to talk to you a different way because you're getting frustrated or upset.
Do you feel like in terms of AI, we're just scratching the surface of how it's going to affect investment advisors and your interaction with them?
100% scratching the surface. We're starting in these safe places like the example we just used. I feel like it's a ways off before we can really rely on that for portfolio solutions.
Yeah.
That's a ways off, and there's regulation we've got to consider.
Okay, yeah, which is why we talked about regulation in Washington with Rick Worster. Jelena, thank you. This was fun. Jelena
thank you all.
Kerr, she's Managing Director of Client Experience at Schwab Advisor Services. You are listening and watching Bloomberg Business Week here in San Francisco.
This is Bloomberg Business Week with Carol Massar and Tim Stenbeck on Bloomberg Radio and Television.
All right, everybody, you are listening and watching Bloomberg Business Week on YouTube, on Bloomberg Originals, and, of course, on Bloomberg Radio. Carol Massar, Tim Stenbeck, live here in San Francisco at Schwab Impact 2024. Some great conversations that we've already had on this Thursday, and we've got an hour coming up where we are just going to lean into the Schwab investment team. So we're going to talk U.S. stocks with Liz Ann Saunders. We're going to talk global international with Jeffrey Kleintop, and then we're going to do some fixed income.
Yeah, Kathy Jones is going to be joining us to talk fixed income a little later. So we sort of have everything covered. One thing we're not hitting on, which I want to hit on now, is what's happening in Washington, D.C. You look at the most read stories. in the last 1 hour on Bloomberg. Matt Gaetz withdrawing from consideration as Attorney General. That breaking just a couple of hours ago. He said in a post on X, quote, "It is clear that my confirmation was unfairly becoming a distraction to the critical work of the Trump-Vance transition. There's no time to waste on a needlessly protracted Washington scuffle. Thus, I'll be withdrawing my name for consideration to serve as Attorney General."
I will say our reporting say that since Gaetz, his nomination was announced last week, it really did seem like he had an uphill battle for confirmation, and that he dropped out after it became clear that the former congressman didn't have enough support in the Senate to gain confirmation. This is according to a person familiar, and again, our team on the ground reporting. Chris Strom has a great story on the Bloomberg and also at Bloomberg.com.
Yeah, the backdrop here is the Justice Department investigating Gaetz for alleged sex trafficking of a minor, but informing his lawyers last year that the probe was closed without charges. He did come under intense scrutiny in response to a long-running House Ethics Committee investigation into allegations that he engaged in sexual misconduct. I think the big question is, what does he do from here? Because he did resign from the current Congress. He did win re-election. He did say he would not serve in the next Congress, but there are questions up in the air. Okay, could he run in the special election? There is a Senate seat that could open up in Florida if Marco Rubio gets confirmed as Secretary of State. So would Governor DeSantis choose Matt Gaetz to serve in that Senate seat? Lara Trump also is a name that's been floated there. So we'll see what he does. I imagine he will still be closely involved with the incoming Trump administration in some way.
Yeah,
he's been a close ally of the president-elect.
To make the assumption, and we're going to ultimately see who gets confirmed, who actually is in the seats from the nominations from President-elect Trump. So we will certainly see who ends there and then what it means for policy. I do just want to go back to the market because we have had some swings in NVIDIA coming off of their earnings yesterday. So that has certainly been at play. We do have stocks higher kind of across the board here. There is still some concern about the war in Ukraine, and traders also just thinking that this new administration, there'll be deregulation, a lot of business or supporting policies, and then you've got Bitcoin going past $98,000 on its way to 100K, dollar up, treasury yields are higher, so it's an interesting market environment. We've talked a lot about crypto, even with Rick Wurster, incoming CEO here at Schwab. He'll take over on January 1st. He's currently president, but that's
Bitcoin up another 4% today. The question is, was it priced in that SEC Chair Gary Gensler would be out of the job by the time President-elect Trump takes office, January 20th, and came out and said, yes, I will resign?
And I just think it's fair to say that at this point, at least the rhetoric, the conversations, the narrative is a much more supportive administration for crypto policies, right, and oversight. So I think that's the expectation, but we'll see.
Yeah, we'll see also if the U.S. does set up a strategic Bitcoin reserve, as the president-elect has talked about, but also as Senator Cynthia Lummis of the state of Wyoming is very interested in doing. She's been talking about this for a while.
So if we do that, do we need the dollar then?
I don't know. If we do that, we need to convince taxpayers that spending money to buy crypto or spending money to buy Bitcoin is a good idea.
That could be a tough sell.
U.S. already does have quite a bit of Bitcoin. It's been confiscated from alleged criminals.
But it's not like we've been buying it.
No.
It's just confiscated.
Yeah. And usually it's used to pay back victims of crimes.
Okay.
But some are saying, oh, well, let's use that.
But it's not like we're selling treasuries, raising money, and buying crypto. Not yet.
Not yet.
I'm just looking at the S&P 500, folks. Broad-based rally, 437 names to the upside on this Thursday. So we have seen investors certainly tapping in. The close coming your way right here on Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:58 on Wall Street. We do check markets all day long here at Bloomberg. The Trump trade boosting stocks. Bitcoin making a run at 100,000. The Dow, the S&P, NASDAQ all advancing. We've got the 10-year at 4.41. 2 minutes to go ahead of the closing bell for the equity market. Stocks rose, shaking off early losses, spurred by swings in NVIDIA and angst about the war in Ukraine as traders contemplate a new administration keen on deregulation. Bitcoin blew past $98,000. The dollar gained, Treasury yields rose. S&P right now up 32, a gain of 0.5%. Dow Industrials up 460, up 1.1%. Nasdaq up 10, a gain of just about 0.1%. 10-year yield 4.41%. The 2-year 4.34%. Spot gold up $21 the ounce, up 0.8%. West Texas Intermediate crude up 2.1%. And Bitcoin, major story today, up 4.1%, 98,304. So the S&P now at 59.48 as we wrap up the session. But what about next year? Marianne Bartles is Chief Investment Strategist at Sanctuary Securities.
So we have our forecast for the S&P for next year at 7,200 to 7,400. And yes, that means another 20%. But when we went back and analyzed the 90s, from 95 to 2000, we had markets up 20% or higher 5 years in a row.
Marianne Bartles, and yes, she did say 7,200, 59.48, where we are right now, and that is the sound of the closing bell as we wrap up trading with the Dow, the S&P, Nasdaq, all advancing. Bitcoin, though, perhaps the day's top story, up 4%, 98,240 on Bitcoin. S&P right now at the close, up 31, up 0.5%. The Dow up 461, up 1.1%, and Nasdaq up by less than 0.1%. NVIDIA, after spending part of the day in the red, NVIDIA up by...
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Environment, the services needed, what's going on with money management. And I got to say, this hour is kind of a special one.
It is. Hey, I'm going to just do some breaking news.
You have a headline.
Because I have some breaking news here. A redhead coming from our own Mark Gurman. Apple is racing to develop a more conversational version of its Siri digital assistant, aiming to catch up with OpenAI's ChatGPT and other voice services, according to people with knowledge of the matter. Apple aiming to launch a Siri revamp in 2026 with more in-house AI.
I'm a little sensitive, having just done a big panel here with some great panelists up on stage in one of the keynotes, and it was all about AI. But I do feel like that is continues to be a big part of the conversation, even here at Schwab 2024. All right, so let's get to it, because we want to start kicking off this whole hour talking global equities, U.S. equities, fixed income. We want to start with U.S. equities. We've got a terrific duo to do that. Liz Ann Saunders, Managing Director, Chief Investment Strategist at Charles Schwab here at Schwab Impact, along with Kevin Gordon, Director, Senior Investment Strategist at Charles Schwab. Guys, welcome.
Thank you.
Or I should say thank you for having us.
Yes, welcome to Impact again.
Thanks for coming.
I want to ask you kind of conversations you guys are having about the markets between yourselves about what's going on.
Is
there a debate?
Well, no, it's just such a unique period of uncertainty because of the different directions policy can go. And one way we've been talking about is we're all always mindful of sort of tail risks. I think the tails are fatter because of not just the uncertainty associated with tariffs, immigration policy, but the fact that much of what appears to be the priority of the administration can be done via executive order and doesn't have to go through that congressional. And we learned in 2018 that, a lot of the tariff announcements were done by Twitter. So it's unconventional.
Might be Truth Social this time around.
Maybe. I don't know. He's pretty tight with Elon.
Yes.
Might be Twitter.
So then how do you think about, what can you kind of hang your hat on? Kevin, come on in on the conversation.
Well, I think, one of the hard parts about going back to 2018, 2019 is, as humans, it's natural to go back to a period of time and say, yeah, you can bring out that playbook, dust it off, especially from a tariff perspective. What's harder this time is that we're in a totally different macroeconomic environment where you're still dealing with ripple effects from the pandemic. You're still dealing with a bond market that is a little bit more unruly this time than it was going into the first administration for Trump. So I think that, to Lizanne's point about what can be done unilaterally versus what can be done with congressional approval really needs to be looked at here, especially from an immigration policy perspective, because most of the labor force growth we've had over the past 4 years has been from the foreign-born, workforce. So that, if it gets restricted, I think could be more of a problem.
And then the Fed comes into the mix, because the combination of immigration policies and tariff policies, it's hard to argue against them being inflationary. Mm-hmm. So then you have, what's the Fed reaction function if it's policy-driven inflation?
I based on the first Trump administration, I believe, and I'm not getting political here, I'm just stating sort of a theory. The president-elect loves to look at the S&P 500 and talk about the S&P 500. That's like his report card for how he's doing. If there is an adverse market reaction to one of his policies, I think that would be enough for him to change his tune.
I think not just the S&P 500, I think markets could be the decider, and not just the equity side of things, but the bond market side of things. The bond vigilantes?
Well.
Yeah.
I think the other thing, too, to keep in mind is, it's not as if, because, we know that President-elect Trump is very focused on markets, that doesn't mean that you don't get downturns and you don't get volatility. I mean, if you just use 2017 as a case study, if I came from the future and we were in 2017 and told you we were going to get this massive fiscal stimulus in the form of tax cuts at the corporate and the individual level, you'd probably think that's nirvana for risk assets. But the reality is we had the short vol implosion in 2018. You had a near bear market almost by 1/10 of a percentage point for the S&P in the fourth quarter of that year. And yeah, you bounced back, and 2019 was choppy, but ended up being okay. But it doesn't mean that you eliminate all of this downside risk, especially if it's driven more by tariff-related news and the hits to manufacturing in the U.S. that are associated with it.
Speaking of the hits to manufacturing, if you look at the ISM Manufacturing Index and put a vertical line at the start of the trade war in 2018, it went straight down. Mm-hmm. Now we're at lows in manufacturing, so I don't know that we have a potential implosion from these lows, but it could be something that prevents what was the hoped for pick back up in manufacturing.
I guess I keep thinking about, there's the fundamental stories of companies and profits, right? That really matters. But then you've got to layer on top of that the politics that's going to play out, and that's going to kind of kick investors around. I mean, how are you guys squaring when you're going to have a client call up and say, listen, fundamentally, earnings growth is happening, but here's
but keep in mind that if you're proxying earnings growth at the S&P level, that's obviously biased up the cap spectrum. You've got 43% of the Russell 2000 are non-profitable companies. You've got a similar share that's zombie companies. So I think there's a much wider spread, especially when looking on the cap spectrum.
Okay.
But it often gets masked by virtue of there's so much focus on the large cap indexes.
Well, funny that you say that, because I feel like the last 2 weeks, everybody keeps coming on and said, guess what? It's small caps' turn. Again. So is it?
But not monolithically.
Okay.
Again, when you look at an index as large as the Russell 2000, to sort of just blanketly say, yeah, small caps look good, I think that there are interesting opportunities.
I heard zombie companies that you said.
Yeah, those with not sufficient cash flows to pay even interest on their debt. So I think, our thesis around factors has been, there's opportunities down the cap spectrum, but you don't want to sacrifice quality.
Yeah.
And to that point about quality, I mean, if you just used positive earnings on a trailing 12-month basis, so earnings of EPS above zero as your only criterion for the Russell 2000, and you took all of those companies, it's about 800, 900 and change. As a group, on average, they're up by almost 45% over the past year. So there are pockets of small caps that have worked. It's just not equally distributed because of the interest rate environment we've been in, and also the growth environment. And by the way, all of these pops that you've had in the Russell 2000 from time to time over the past couple of years, every time they get a little bit of momentum and everyone thinks it's changing for them, it hasn't been consistent with the turn in forward earnings growth and expectations. So until I think you see that actual move where conviction starts to build from an earnings standpoint, it's tough to get bullish on the index as a whole. But to Lizanne's point about, a large chunk of it being not profitable and zombie-like, it's just tough to look at it
even within the
monolithically.
NASDAQ, if you look at the top 10 best performers this year in the NASDAQ, none of them are large cap stocks. They're all small to medium cap. None of them are in the Mag 7. So I think we get in this sort of tunnel of the mega cap tech and tech related names, and there's less analysis happening on everything else.
On an index level, Lizanne, are you concerned about the power of those mega cap tech companies? It's a question I could have asked 5 years ago. It just wouldn't have included NVIDIA.
I think the problem of concentration and the perceived need to be in those names in order to do well, that's an institutional problem. That's not an individual investor problem. If you're benchmarked against a cap-weighted index, you are at the mercy of what those largest names, their contribution to the index. But for individual investors, they're not benchmarked against the S&P 500. They don't have to take that same kind of concentration risk. And it's another point behind that, what I just mentioned of, top 10 best performers in the NASDAQ. They're all small to mid-cap stocks. Only one of the Mag 7 is in the top 10 best performers of the S&P 500.
Right.
So I think you don't need to have that concentration risk if you're not professionally benchmarked against the S&P.
What do you think are the biggest risks right now? Do we have clarity on it for 2025?
I mean, from a policy standpoint, that's probably the easy one to throw out there. But I think just the lack of clarity from
policy, meaning government,
Washington
or also
policy.
Fed policy?
More Washington policy, but I think they're tied together now.
Yeah.
Because I could see a scenario where if you do get more restrictive labor force growth coming from the outside, but also if there is a chunk of the labor force physically removed from the country, that's probably an inflationary problem. And I've also yet to see...
I love that you guys are going there, because I don't think people realize, we certainly heard from CEOs that they are so worried that they're not going to have access to a labor force and what that means for their ability to do things.
100%.
It's an increase in the cost of labor.
Labor costs, right?
And it's a decrease in labor supply. There's the demand side of that as well.
It's a supply shock and a demand shock.
I can't get a CEO to seriously explain that will affect them at this point in the last 2 weeks. Even if they don't employ people who didn't come to this country illegally, right?
How often do you talk to smaller company CEOs?
I recently
we do actually talk to.
We do. I talked to
in the spaces where migrant work is a larger
construction,
share. In
services, hospitality.
For construction, I mean, almost 20% of the construction sector is undocumented.
I have two brothers
workers.
who are contractors. They're they can't find work.
But I think the important point is that it's not just you could run a company that doesn't employ any undocumented workers. You're still going to see labor costs rise.
Right.
If 11 million people are taken out of this country who are doing work.
That's right.
Yeah, it's a demand shock, it's a supply shock. And I think we sort of lose sight of the fact on the demand side, especially because the supply side is looked at maybe sometimes more of an issue in terms of the makeup of a particular industry or the makeup of the labor force. But if you're taking demand out of the country, but you're also not being able to fill the supply hole that you're leaving, that's sort of a stagflationary shock.
So what does it do to the market if that policy ends up coming to fruition?
Well, I mean, I think it depends if it's phased over time. But
and we don't know the logistics around whether we even possibly could get to the high end of what the campaign pledges.
The reality
on
of
that
it, right?
front. But Peterson Institute, I don't know if you guys saw it, just did a study on, okay, let's take it to the extreme, both on the immigration side of things, on the tariff side of things. And they actually added an interesting little wrinkle into the mix if there continues to be a threatening of Fed independence. All three of those collectively are unquestionably higher inflation, lower growth kind of backdrop. Now, the real answer may be somewhere in the middle of nothing gets done and the extremes, both on immigration and tariffs.
But it's a wait-and-see mode, right?
Yeah, even on the tariff front, I've yet to see a model in all the research that we read. I've yet to see a model that doesn't suggest it's a stagflationary shock, where over time you get this boost to inflation, but you also get a hit to growth.
I want to go back to the market as kind of a clearinghouse for all of the information, because I do feel like the market smacks down policies or initiatives very quickly. I feel like much more than it did, 10 years ago. Maybe it's because of social media and stuff just filing through. Do you assume that will continue and that will send messages to Washington and maybe so that things aren't so severe.
It will send messages. How much they're heated, that's we don't know. But
especially when I think about the Fed and the independence of the Fed, like that to me would be something that would bring down the markets.
To me, the most fascinating part of Powell's press conference at the most recent FOMC meeting was the definitive no. As soon as that happened, I thought that's the headline, and that should be the headline. So I don't worry about that piece of it all that much. But all of this gets to what one of our theses is that this sector dispersion, these rapid fire rotations that are happening at the sector level are going to persist.
Yeah.
The drivers going forward may be more specific to things like tariff policy announcements. And we saw that in 2018. There was, that voting mechanism that happened so quickly with markets maybe doesn't appear acutely at the broad index level, but I think you're going to see it at the industry level, at the sector level, tied specifically to both tariffs and immigration.
Makes sense.
Yeah. Hey, we're speaking with Liz Ann Saunders, Managing Director, Chief Investment Strategist at Charles Schwab, on site at Schwab Impact, along with Kevin Gordon, Director, Senior Investment Strategist at Charles Schwab. Kevin, I believe a year ago we were sitting here, it was October of last year in Philadelphia. The S&P 500 is up 40% since our conversation with you.
Who'd have thunk?
Who would have thunk?
And what was interesting, too, I remember talking to you guys about the unique nature of this bull market, and at that point it had been so unique where even for something like small caps in the Russell 2000, it was breaking new bear market lows, and that has just never happened before. You also had sectors in the S&P that had not been up, and that was just so unique about what the structure was of the bull in its early phases, where typically, even after you go through a non-recessionary bear, you do tend to see a lot of participation at any sector level, at any cap level, but we just haven't seen that. But I will say, and what's been nicer to see this year is that participation has really improved, especially since that midsummer mark where the Mag 7 really started to take a little bit of a step back, not outright decline, but take a step back. Tech took a step back. Even semiconductors recently, I find the weakening in that breadth profile actually just fascinating, while the rest of the market has actually been able to power forward. And that's, I think, what has actually been lost in all of the election-related narrative recently, especially around some of the strength around areas like financials. Financials were strong heading into the election. Industrials were strong heading into the election. So it's not as if you got this massive shift in the leadership profile of the market. And I think that's been a relatively healthy thing.
But all year, there's been massive churn under the surface of these cap-weighted indexes. So the NASDAQ had a 13% drawdown in that, midsummer period of time. But the average member drawdown for the NASDAQ is 47% year to date. So sometimes when people talk about the market, it sort of begs, well, what piece of the market are you talking about? These cap-weighted indexes.
I love that you do that. I know we all throw it all in the basket, and it's
right.
It's dangerous, actually.
And we've been calling for a good chunk of the year. We're calling it the Michael Caine duck market. Just calm on the surface, but paddling like the Dickens underneath. Yeah. That's been how we've been describing it.
So all right. So what's the environment for 2025? Can you make a call?
Well, we never make a call.
Okay. I keep worrying. What are we missing? We haven't had a recession. We have had pockets of recession.
We've had the roll through.
So are we done with it then?
My hope was that we were going to get to a point where if we started to see weakness show up more acutely in the services sector, in large part probably driven by any further weakness in the labor market, that especially if the Fed was in easing mode, you might be in a position to see stabilization, if not recovery, in those areas that have already taken their hits, like manufacturing, like housing. I don't want to say that's off the table now, but it's a little bit more difficult post-election to come up with a case for stabilization and improvement in those areas, especially if the Fed doesn't stay in easing mode. We saw this attempt at some recovery in housing, and then it faltered again, courtesy of the move up in long yields.
I think the other thing, too, from a valuation and a sentiment perspective, is that you're getting pretty stretched across most of the metrics that we track. And it's not just in the traditional attitudinal, how do you feel about the market, AAII, bull bear indicator. It's now filtering over into what are investors actually doing with their money. We've seen equity ETF inflows completely spike. akin to levels that you saw in
But
2021.
money market funds, too, continue to blossom.
Absolutely, yeah. So I think that becomes a little bit more of a risk in the event there's a negative catalyst. We always say frothy sentiment in of itself is not a reason that the market just goes lower. It has to be tipped in that direction. It's just the sentiment backdrop that makes things more vulnerable.
I also don't think we should look at the money in money markets as some giant pool of imminent funds dying to go into the equity market. I think a lot of that is pretty sticky money.
That's exactly
Maybe
it.
1 trillion, 2 trillion will go into the equity market.
Maybe, but not as
People
powerful
like
as
to keep
But not necessarily the equity market.
You got to run. Lizanne, thank you.
It's 421 on Wall Street. We do check markets all day long here at Bloomberg. Sources tell Bloomberg Apple is racing to develop a more conversational version of its Siri digital assistant, aiming to catch up with OpenAI's Chat GPT and other voice services. Sources say the new Siri, details of which have not been reported, uses more advanced large language models, or LLMs, to allow for back-and-forth conversations. After hours, we got Apple a little changed, down less than 0.1%. Reporting earnings after the close of trading, we did hear from Intuit, the maker of the TurboTax tax preparation software. It is falling in extended trading, little changed right now. This after giving a sales and profit outlook for the current quarter that did fall short of analyst estimates, disappointing investors investors looking for a boost from the company's new AI products. Also reporting after the close of trading, Gap, it raised its full-year outlook for sales, with the apparel retailer saying all of its brands are gaining market share. An update today for the Dow, the S&P, and the NASDAQ Composite Index. S&P up 31 to 59.48, up 0.5%. The Dow up 461, up 1.1%, while NASDAQ was up 6 points, little changed. 10-year at 4.41%, the 2-year 4.34%. Gold up $19 the ounce, up 0.7%, and West Texas Intermediate crude up 2%, 70 cents a barrel. Bitcoin now at 98,139. Bitcoin surging today by 3.9%. Recapping, S&P up 31, a gain of 0.5%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie Pellet. Do appreciate it. Well, last we just talked about U.S. equities. It's time to go global, which for many years has lagged the U.S. Let's just go to the numbers here, because over the last decade, the S&P 500 has, on average, returned 13.15%. The FTSE Global All Cap ex-U.S., it tracks stocks in developed and emerging markets outside of the U.S., that's only returned about 5.25% on average, a difference of nearly 180% over the last decade. So some serious underperformance. It's been hard to beat the U.S. when it comes to equities gains this year and this last decade. Here with the global view and where there are opportunities around the world, we got Jeffrey Kleintop with us. He's Managing Director and Chief Global Investment Strategist at Charles Schwab. He joins us here in San Francisco. Good to see you again. How are you?
Great to be here. I'm doing fantastic. Thanks for being here.
What's top of mind for you, especially against a backdrop where, gosh, every year it's like this is not international's year.
Yeah, no.
You're not alone. People are like, it's time to
alone.
buy internationally.
Well, and it's for a couple of good reasons, too, right? I mean, the obsession with AI and stocks like NVIDIA have just really been focused on the U.S. market, and tech has been the best performer in the U.S., and tech is the biggest sector in the U.S., and it's not elsewhere. The other thing is that those other economies have been lagging U.S. economic and earnings growth. That could be different next year, though. We're actually already seeing a shift towards financials leading markets overseas. That could be the next step for the U.S. as well, big rate cut beneficiary. In addition, we're seeing global economic growth finally begin to converge. U.S. and China expected to slow next year, but Europe, Japan, Canada, Australia, all expected to pick up economic momentum next year, along with earnings growth. As a matter of fact, here in the third quarter, we're just getting done with the earnings reports. Earnings growth for European companies actually outpaced the S&P 500 for the first time in 5 or 6 quarters. So we may be starting to see a turn there.
But what are you seeing in terms of flows? Because it does feel like investors are still holding back and just kind of all in on the U.S. trade.
They are. And post-election, I think a lot of investors believe, hey, we just had an election, I probably need to make changes in my portfolio.
Yeah.
But they can be detrimental. Think back to 2017, right? So coming out of the 2016 election, America First policies were thought to really help U.S. small caps and really hurt emerging markets. The exact opposite occurred. Emerging markets were the best performers in 2017, small cap U.S. the worst. So not saying necessarily it's a perfect play, again, a repeat of all of that, but the flows can be misleading.
What happened last year? Because we were thinking about our conversations that we had with you and some of the other members of the Schwab team. You were bullish on international.
I was, yeah.
What happened last year that you think, okay, was a surprise, or just why it didn't pan out, or you misread the tea leaves?
Well, a few different things. One, I think the technology thing has just run longer and harder than I thought it would. I thought we'd see a broader
the AI
market.
trade in particular.
Yeah, exactly. And so we didn't see that broadening. I think we're starting to see some of that now, but we just didn't. The other thing was we did see a stumble in the manufacturing recovery. So I was basing this on what I call a cardboard box recovery, that demand for making things and shipping things would pick back up again. It did in the first half of the year. It rolled over sharply in the second half, and the global purchasing managers index for manufacturing back below 50. I think that usually is a lag with central bank policy of about 9 months. We're at the turning point there where I think that starts to pick up next year. So I think it's delayed and not disrupted.
Where do tariffs come into this equation?
Boy,
Because this is a tough one.
Where do they not?
If you're thinking international, you're saying, wait a second. Okay, we get this America First policy coming once again, starting in January 20th. There's a lot of Republicans in Congress right now who look like they're ready to help the president-elect push through that agenda. What do you do if you're an investor outside of the U.S. and you're saying to yourself, wait a second, these companies outside the U.S. could be hit with tariffs.
Yeah, and the numbers are scary. 60% on China, 20% across the board, 200% on John Deere tractors coming from Mexico. If you add them all up, and I have, and you weight them by their import percentages, you get a 26% import tariff in the U.S. on average. That's up from 2.6 right now. That's like Smoot-Hawley level, Great Depression era level tariffs. But I think the reality is going to be quite different from that. I'd look, as an example, in Europe. So Europe on October 28th just slapped 45% tariffs on electric vehicles from China. Within 2 days, Chinese delegates were there working out a way to get rid of those. They seem to make some technical progress over the last couple of weeks, maybe scrapping those tariffs in favor of import quotas, which is a far less disruptive way of doing things. So I think that's probably maybe a way we can look at what the future path of tariffs might look like.
Jeff, how do you think about the pushback in globalization? We have a lot of CEOs say, listen, it's not going away. Yes, supply chains are changing. We're doing more nearshoring or onshoring. But I'm just curious how what's going on in globalization, wars around the globe, how that is impacting the international investment play.
So it seems like there are multiple supply chains now instead of just one, right? So you don't just assemble your product in the cheapest labor market. You're going to have multiple supply chains. And that seems to be what's happened.
Is that good for companies' costs, their earnings, what their balance sheets look like for their investment potential?
But it's less efficient, so it should be more costly. At the same time, we've been able to miniaturize manufacturing globally in a way that's made it not as inefficient to have multiple supply chains as it used to be. And with perhaps AI, robotics, a number of these potential innovations, we could maybe scale that even further to where it's less of a drag on corporate profits.
Interesting. Okay, so how do you see this happening outside of the U.S. versus inside the U.S.? If we're thinking about the companies that are doing this type of innovation, who are the beneficiaries here?
Well, I mean, I think it's those that are really looking to scale up their productivity per worker. So you're looking at healthcare, you're looking at financial services. Those are two areas very much more representative outside the U.S. than inside the U.S. So the potential for productivity gains, I think, are skewed to those businesses. Financials are the biggest sector outside the U.S., and there's a whole lot that can be done with AI there.
All right, we know you don't do individual stocks, but when you look at around the world, and I do feel like I just want to talk some regions. I think about Japan, and I do feel like the momentum this year has definitely changed on Japan. Give us kind of your thoughts about what we see in 2025.
So I think you see rate hikes from the Bank of Japan. And so I think that begins to bring some strength back to the yen, and we start to see some capital come back to Japan. We've got a number of businesses really ramping up their share buybacks and their dividends. And so the return to shareholders seems to be picking up. And so if we get a manufacturing recovery, that's what Japan does. Right. And so if we get that global manufacturing recovery, I think that does disproportionately benefit Japan.
What about Europe in terms of wars and stuff? So what's the kind of smart, I hate to put everything into a bucket because I don't think that's fair, but what are you thinking about for 2025 in terms of where are the pockets of opportunities in particular for investors and where maybe not so much?
One of the things I think Europe might look to do is buy U.S. weapons to fund the war in Ukraine, to narrow the trade deficit with the U.S., avoid across-the-board tariffs, and actually achieve maybe their objectives in keeping Russia at bay. One of the things I think that's interesting is European automakers. They could be in the crosshairs of Trump tariffs, right? The stocks fell 7 to 9% right after the election, but they've stabilized. They've started to rebound because I think if you look at what's likely to occur, maybe we go from a 2.5% tariff on European cars to 10%. That will be equivalent to the U.S. tariff. That 7.5% increase in tariffs has already been offset by the fact that the dollar's up 5% versus the euro, right? So we've already kind of adjusted for some of those factors, and I think therefore that 7 to 9% decline in those stocks may be further reversed.
What is the region of the world where you're most optimistic?
I think it probably is Europe. One thing, because price-to-earnings ratios are pretty attractive. They're below their 10-year average.
So just great good deals, valuation.
Yeah, I mean, take a look at the difference between Coke and Nestle. Nestle trading at a 4 PE discount to Coca-Cola. They have literally the same customers and operations around the world, but you're paying a big premium for Coke because the investor base is different. So I think that comes back. I think earnings growth does pick up next year. We're already starting to see signs of that. And then 5 rate cuts by the ECB by June of next year versus maybe 2 for the Fed. I think that ease of financial conditions really does help to support that rise.
I'm glad you went there because I do think a lot about the differences in central bank policy, right, based on their specific outlooks and what that gap means in terms of opportunities for investors. And you're saying that spread between what Europe does in terms of monetary policy versus the U.S. could provide opportunities.
It's a drag on their currency versus the dollar. Obviously, the dollar would go up, but maybe that's a few percentage points. Each point of PE expansion in Europe from 14 is a 7% gain on prices. So you get 1 or 2 of those, and that's going to outweigh anything you're going to get in terms of currency drag.
I want to go back to Carol's question about the war, because if you are most optimistic about Europe, how do you factor that into how you're thinking about the region? Because there is a chance that with the incoming Trump administration and the rhetoric around how they want to support Ukraine or they don't want to support Ukraine, that there could be a risk of that war ending and Ukraine losing.
There certainly is a lot of uncertainty over the course of next year in terms of where they draw borders into some type of ceasefire agreement, and in anticipation of that, both sides trying to gather territory and try and redraw those lines. Ukraine is funded through 2025. Most governments have already committed those resources. There's a lot of weapons on the way. So the whole idea of a day one ceasefire probably doesn't seem likely, but somewhere over the course of the year, perhaps. Where those lines are drawn, I don't know. But I do believe that there's going to be a lot more spent in terms of defense in Europe, and that could have some stimulative aspects.
Jeff, we've all been doing this a long time and seen a lot of different market cycles. And I'm just curious how you're thinking about, the investment environment for the international play or global play today versus kind of where it was a few years ago. Is it more difficult? Is it more transparency? Give me some thoughts on that. You've seen a lot of market cycles.
Yeah, so this one is so much tied to sectors, I think. So the U.S. is basically a tech ETF. And nothing wrong with that. It's just recognizing it. But there are other countries that align with a particular sector as well. Germany is an auto ETF. Australia is a metals and mining ETF. Canada is a financials ETF. So if you think about sector diversification, you may love the U.S., but honestly, it's a tech ETF. So if you want some sector diversification, move away from just what has become really kind of a really concentrated AI play, you need that international diversification in your portfolio. And that's a different way of thinking about it than maybe in the past.
30 seconds on China.
China is very likely to slow next year. They're not allocating the resources to the consumer and to the property market. It's still a strategic focus on self-sufficiency and semiconductors and so many other things. So slower growth, but not really rebound.
What type of ETF would it be?
Yeah.
What? At this point, maybe an infrastructure ETF. Yeah.
Do you still feel like we're lacking transparency in China? Just got about 20 seconds.
I think it's getting better. I don't think the same incentives to create the same type of economic data that we create in the West. Yeah.
All right. Great stuff. Thank you so much.
My pleasure. Thanks
Around the world we went. Well done. Well done. Jeffrey Kleintap, Managing Director, Chief Global Investment Strategist at Charles Schwab, right here at Schwab Impact. All right. We've talked U.S. stocks. We have talked global stocks. You know what's coming up next?
Fixed income. Kathy Jones.
Yeah. They've had a boring world.
Oh, my gosh. Looking forward to that conversation.
Strap yourself in. Get ready, because it could be a little crazy. It could be a bumpy ride, as they say. This is Bloomberg Business Week.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks ended the day higher as traders contemplated a new administration keen on deregulation. Bitcoin blew past 98,000. The dollar gained. Treasury yields rose. S&P up 31, 59.48, where we stand, up 0.5%. The Dow ends the day at 43,870, up 461 points, up 1.1%. The Nasdaq Composite Index higher, little changed, up 6, a gain there of just about 0.1%. 10-year 4.41%, the 2-year 4.34%. Gold up 0.7%, 26.68 the ounce. West Texas Intermediate crude up 1.9%, 70.07 a barrel. And Bitcoin up 3.8% right now, 98,027 on Bitcoin. Sources tell Bloomberg Apple is racing to develop a more conversational version of its Siri digital assistant, aiming to catch up with OpenAI's ChatGPT and other voice services. After the bell, we heard from Intuit, the maker of the TurboTax preparation software. It is lower in extended trading after giving a sales and profit outlook for the current quarter that fell short of estimates, down now by 4.7%. Gap raising its full-year outlook for sales, with the apparel retailer saying all of its brands are gaining market share. After hours, we've got Gap now up by 13.1%. So it was an update today for the Dow, the S&P, and NASDAQ. S&P 500 index today up 31, a gain of 0.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That's a Bloomberg Business Flash.
All right, thank you so much, Charlie. Well, bond investors searching for some direction today. This is, there's so many factors. You've got Russia's escalation of warfare in Ukraine. You've got the murky outlook, for what the Fed's going to do in their interest rate cut policy going forward. And then there's the leadership of the U.S. Treasury Department. There's a lot of dynamics very important to the Treasury trade going on right now.
Yeah, there are also traders thinking about, okay, what's the Fed going to do for the remainder of the year and next year? Well, we got two great voices who focus on fixed income strategy at Schwab. With us now, Kathy Jones, Managing Director, Fixed Income Strategist, and Colin Martin, Director, Fixed Income Strategist. Good to have you both with us. How are you?
Good. A little tired. Been a busy week, but...
Nothing going on in the Treasury trade this year.
Not a thing. Not a thing.
Well, I do want to start with you, Kathy, and how you're thinking about what the Fed is going to do, and if that changed at all, given the election results a couple weeks ago.
Yeah, I think the case for a pause is growing a bit stronger at this stage of the game. So, we've had stronger than expected economic data now for a while, particularly like the retail sales telling us the consumer is doing well. And so then the question is, does the Fed really need to cut rates to help out? We have very easy financial conditions as the stock market keeps going higher and credit spreads get tighter. And so, and then we have all the uncertainty about what fiscal policy will be going forward. So we don't know what tariffs will or won't be imposed. We don't know what tax policy will be and how it will affect both economic growth.
That's a big, if list, or what might happen, right?
And then immigration reform, which I particularly think is one of the most important components for inflation and growth going forward, because again, we don't know what the actual policy will be, but if you kind of take things at face value, that could reduce the workforce by 7 or 8%. That's a huge issue.
So, Colin, you and Kathy have to figure out, though, fixed income strategy and what you're thinking about, right? People look to you to kind of get an idea of what's to come maybe in 2025. So what do you feel comfortable kind of saying right here on this Thursday afternoon about that?
Yeah, well, we've kind of revised our guidance a little bit lately because of so many of the uncertainties that Kathy just highlighted, where there's this wide range of outcomes because of the proposed policies, what gets implemented, when they get implemented, and what that impact is. So given that, and given I think the risk is to higher yields than lower yields if we do get some sort of inflationary impact. So our guidance now, our main guidance for investors, is to really focus on a benchmark or below benchmark average duration. We don't think it makes a lot of sense to dive in with long-term bonds right now because of the risk to those prices if they fall. I want to make it clear, though, that's a tactical idea. From a strategic standpoint, we still think the yields are pretty attractive. So if you're an investor, you're looking for 4, 5, 6% yields, you can get that right now if you have that time horizon. And if that's going to help you reach your goals, then I think that's really attractive right now. But just be prepared that if we see yields inch up. When we talk about our upside, maybe we go to 5% on the 10-year Treasury yield.
Wow.
But
Maybe, likely, possibly.
Possibly.
yes.
Okay.
To all three.
Yeah. So, what we do is we try to model out, we deconstruct the 10-year yield, and we try to model out, well, if we change this component, what happens in that component? Or if you just look at the spread between...
There's a lot of components to play around with right now, right?
Exactly.
Yeah.
Or you just look at the spread between the Fed funds rate and 10-year yields. Historically, it can be, 100 to 150 basis points. So if the Fed can't go below 4%, you could easily get to 5% plus just based on history. But we do think the Fed will get below 4% by some amount. But again, a lot of ifs in there. And so we're just trying to be as cautious as we can right now without giving up too much income.
Hey, Colin, play that scenario out for us if we do hit 5% on the 10-year. What that looks like, what the implications of that are for the economy. And, I think a lot about different areas of the market that have expected lower interest rates.
Mm-hmm.
If we don't get those, what happens?
So I think what it looks like, I think it looks attractive. And I think if we get there, I think that can draw in a lot of demand. I think whether it's domestically or internationally, I think there'd be a lot of demand, especially that we're seeing these interest rate differentials. We're seeing other central banks expected to cut more than the U.S. So I think that's number one. Two, what happens to the economy and to borrowers, I think it's more of a mixed bag right there. Because if you look at both the consumer side of the equation and what I focus on in the corporate bond market, corporations just haven't really had that negative impact of rising interest rates. Something I've looked at recently is...
Why?
So because they did the same thing that homeowners did. They locked
the refi,
in.
Right?
They refied. So if you look at, I'll use high yield bonds for example. The average,
which is having a moment.
They're having a moment. Spreads are at 15-year lows. The average coupon rate. Now there can be higher or lower, but the average coupon rate of that index is right where it was in 2019. It's risen a little bit over the past year or so,
right?
But because companies just refinance. So if rates keep rising from here, although the trend is the opposite right now, but if they were to move up a little bit, that would impact the leveraged borrower. But for the most part, their fundamentals are pretty strong.
So the opportunities, so when, someone comes to you and says, so where are the best opportunities right now? If I want to put some money in the fixed income area, Kathy, what do you say?
Well, again, if your time horizon is 5 years plus and you're willing to kind of ride out the ups and downs, you're looking at 5 to 5.5% yields without taking much credit risk. So it's either the investment-grade corporate bonds, if treasuries, MBS. If you just look at the ag, your total return is going to be pretty attractive and your income stream is going to be important. So keep in mind, we had a rocky period in 2022
right?
Because there was no coupon income. We're coming off zero. Now we're starting with coupons, close to 5%. That keeps your return much more solid going forward. So, we like higher credit quality in general, but definitely lots of places to lock in that yield.
Oh, go ahead. No, you go.
I wanted to talk a little more macro and think about policies come January because, Kathy, you mentioned a lot at the top when it comes to the labor market, when it comes to tariffs. Do you believe these policies are actually likely to be implemented given that they actually could have severe economic consequences?
I have no idea. And I will be honest with you because we know that one thing that President-elect Trump has been in favor of forever is tariffs. So we do believe pretty strongly there'll be some sort of tariffs. Now, will they be modified? Will industries affected by the tariffs be subsidized as they were in his previous administration with the farmers? We don't know the details of that, but tariffs seem very likely. After that, really hard to say. Tax policy and immigration, hard to say what will really happen.
Just got about 30 seconds. Is there a moment in time that you're thinking, okay, maybe 6 months from now, 8 months from now, we'll have much more clarity about what this new administration can get done and we can be more definitive in terms of our thinking about going forward? Is there a time frame that you're thinking about for next year?
Yeah, I think when they actually have to debate the Tax Cut Act that will be expiring, then we should get a better idea of what Congress is willing to do.
Final thought from you?
Yeah, no, I would agree. I think yes, we'll have more clarity just because more time will have passed. But I think we're going to have a lot of uncertainty over the next year, 2 years, 4 years. So yes, more clarity, but not all the answers that we're going to need.
Keeping us on our toes again. Thank you both so much. So appreciate we could kind of finish up with the fixed income trade. It's been such an important one, no doubt about it, and something we've been following so closely. Kathy Jones, Managing Director of Fixed Income Strategist. Colin Martin, Director of Fixed Income Strategist right here at Schwab Impact. When we come back, some final thoughts and maybe a quick look at the most read. This is Bloomberg.
listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
It is Bloomberg Business Week. That's Carol Masser. I'm Tim Stenevec, live here at Schwab Impact 2024. 4,500 folks here in the building at the Moscone Center.
Oops.
Put your microphone on.
Sorry.
Sorry. Hey, what would you like to hear about on Bloomberg Radio? Help make shows like ours even better by taking our Bloomberg audience survey. Visit youtube.com/Bloomberg Podcast and click the link in our profile or community section to take the survey, which is hosted by our partners over at Material. Fill it out now at youtube.com/Bloomberg Podcast or scan that QR code. It's right there on the screen.
Yes, indeed. We want to hear from you. We've been hearing from a lot of folks actually who've been coming up to our booth as we've been broadcasting here in terms of what they like, what they want to hear, but we definitely want to hear from all of you. Send us some feedback. In the meantime, one of the big topics that we've talked about with all of our guests here from Schwab Impact is the impact of the election outcome. Who is going to be in the top spots when it comes to the financial industry? What's going to happen with tariff policy, with tax policy? And on that, I think there's been a lot of questions, too, about the individuals who are being put in place and potential for conflicts of interest, right? And typically, you take on a government job and you got to think about your business business investments, I should say, or connections, and what you do to make sure that there is no conflict of interest. And on that, we've got a most read story on the Bloomberg when it comes to Howard Lutnick.
Wall Street billionaire Howard Lutnick plans to step down from his 3 businesses and divest interest in his 2 public companies if he's confirmed as Commerce Secretary in President-elect Donald Trump's administration.
Yeah, so the chief executive, Cantor Fitzgerald, he's going to divest his interest in brokerage BGC Group and property firm Newmark Group. He doesn't plan to sell shares on the open market, he said, though, in separate statements issued by those firms. So keep in mind, Cantor, his firm, includes an investment bank, fixed income, equities business. It is private. It's also interesting because there are different areas that he's been looking. I think is it crypto that's one of them?
Yep.
A lot of different areas that we know will be a part, or we expect it to be a part of this new administration. So it's something that certainly we are all watching very, very closely.
There's also a really interesting sort of loophole for folks who want to join the federal government and sell their assets when they're part of an administration. It allows them to defer taxes on assets that they sell, so they might not necessarily have to pay income taxes or capital gain taxes on what they sell, at least right now.
So in other words, being forced to kind of sell at a moment in time that might not be of their choosing, they get this tax break. That's essentially what it is.
Asset prices are pretty high right now. So.
Excuse me.
Maybe it's not what they're choosing, but yeah, it's not so bad, I think, for a lot of folks.
Still the most read story on the Bloomberg.
Consult your financial advisor or tax professional. Don't take my word for it.
Says Tim Stenovec. Most read story on the Bloomberg in the past 8 hours, Matt Gaetz withdrawing from consideration as Attorney General. So that's your most read for the day. If I take a look at what is the most read on the Bloomberg in the past 60 minutes, has to do with an expert field hedge fund boss joining the billionaire's family's firm.
You want to talk Apple a little bit?
Oh, yeah, we said we wanted to talk about it before.
Apple's readying a more conversational Siri in a bid to catch AI. OpenAI. The company's racing to develop a more conversational version.
Siri's had its problems.
It is.
I don't know how many times.
Don't say it too much or else your phone's going to go off.
I don't know how many times you've argued with Siri. I know in our house we argue with Siri a lot.
What do you guys argue about?
Sometimes it gets a little ugly.
Really?
Because it doesn't always hear what we...
Okay, it makes sense that you're arguing. Siri's 13 years old, so she's, a teen.
Tween? She's a teen. She's a tween.
Tween, yeah. It's a part of
She's
Apple's
a she,
efforts.
right? Siri's a she.
I have Siri set as an Australian man.
Of course you do.
I do.
Do you really?
I do, yeah.
I know. What is it that we do a voice, even with Waze? I think I have my husband's like, I like the British voice. I'm like, okay.
I got the Australian male voice. My kids think it sounds like Bluey, so.
Some shrimp on the Barbie?
Whatever you want. The interesting thing is they are racing to develop, to catch up with OpenAI, but they also have this partnership with OpenAI as well.
Doesn't everybody?
Yeah, you kind of have to. The new voice assistant will be eventually added to Apple's intelligence, is dubbed LLM Siri by those who are working on it. LLMs are a building block of Gen AI. They gorge on massive amounts of data in order to identify patterns and answer questions.
Company planning to announce the overhaul as soon as 2025 as part of the upcoming iOS 19 and macOS 16 software upgrades, which are internally named Luck and Cheer, according to those in the know. Like Apple Intelligence this fall, the new features will not immediately be included in next year's crop of hardware devices. Instead, Apple is currently planning to release the new Siri to consumers as early as spring of 2026. So you're going to have to wait a little bit, about a year and a half from now. Given that Apple's still several months away from announcing the plan, the timing and features could still shift. But I have to say, in my world, I do talk to a lot of devices.
You do?
Even turning on lights and weather. There's a lot of things that I do a lot.
I had a little technology interaction last night.
Can you tell us about this?
Yeah,
you have been so excited about this.
I was with a friend last night. She asked, who lives here, and she asked, have you taken the Waymo yet? And I said, no, I haven't taken the Waymo. I'm not on the waiting list. And she said, you don't have to be on the waiting list anymore. Just download the Waymo app, and you can hail a car like you would an Uber or a Lyft.
And you did it.
She dropped me off at a place within San Francisco where I could do it. I did it. I've seen the future, Carol, and it is self-driving cars.
You loved it.
I thought it was awesome.
I am amazed.
It was nighttime. It was raining. This thing was flawless.
Did you relax?